Hello, everybody. Welcome to the Sales Lab. My name is Anthony Grost, host of today's program. Today's discussion is all about the current condition of our housing market and the forecast for next year. As all of you are aware, we've had nearly 10 years of market growth. However, now we have low inventory, supply chain issues, rising interest rates and prices, declining buyer sentiment. So next year is not so clear. So to help us clarify our market and share and give insight as to where we're headed, I've invited Tim Sullivan of Zonda to our program. For those of you who don't know Tim is the Senior Managing Principal of Zonda Advisory. And Tim has more than 36 years experience in analyzing value and valuing real estate developments and opportunities across the U.S. He's a wealth of information and insight. I'm excited to have him on our program after recently hearing him speak at the 2022 Residential Real Estate Sales Forecast with Jeff Shore. So Tim, welcome to our program.
Thanks, Anthony. It's great to be here. And I'm not sure there'll be a wealth of information, but I certainly will try to find a few pennies or nickels worth of ideas for everyone to take home.
Well, I think it is a wealth because I think all knowledge is a true capital. Knowledge is really what helps the builders and everybody really plan for what they're doing. So I'll take nickels, dimes, and quarters. So when we look at the U.S. housing market, what is the overall health of our housing market right now?
Well, remember that there is no such thing as a unified U.S. housing market. It's so diverse. It's diverse by state, by metropolitan area, by submarket, by neighborhood. But if you want to just generalize, I'd say it's a pretty healthy market. And you opened with the right points. We've got relatively low interest rates. They may pop up a little bit, but I don't think there's a case for a radical increase anytime soon into 2022. We do have limited supply, which is a double-edged sword, pushes prices up. You can't find what you want, where you want, when you want it. And then we also have home builders that I think are pretty healthy when it comes to their financial situation, but they're frustrated from an operational standpoint because we have the supply chain challenges. And like in every industry, things are taking longer. So that has a whipsaw effect into pushing prices up once again and kind of frustrating the consumer. But all of those things together, I think you could say it's a pretty healthy market. And into 2022, I'm pretty positive about the way we're going to go.
Yeah, and I feel the same way. You know, I'm a little shy about demand disruption because nobody foretold COVID. But yeah, there's a lot of positives out there in the market. Now, you mentioned, and you bring up a very good point. The U.S. isn't one market. It's a combination of many, many markets, different dynamics out there. So at Zonda, how do you evaluate housing markets? I mean, what type of data are you analyzing and looking at to evaluate a market?
Well, if we zero in only on housing, I'll answer that a certain way. Okay. But if it's, let's say you and I are working together in the Puget Sound area and we're trying to define ultimately demand. Well, we're going to look at some of the macro indicators like job growth, population growth, wealth, where people are migrating from and also to. Are we losing people? That's the macro stuff that always generates some of the insights on housing. But if you really want to zero in on housing, there's a couple of key things. The first and foremost is, are you talking about new or resale? Because those two compete very directly together. And classically, resale is outsold new 10-1 in the United States. So for every new home, we sell 10 resales. And resale homes have always been kind of the entry level, and in some markets, first and second move up. So we have to understand the resale side of the market to really get a handle on anything. Secondly, we look at pricing. And then third, we're going to look at the dynamics in an area because you might be in a part of the US that is a complete bedroom community and people live there but drive elsewhere. You may be in downtown Seattle, and in downtown Seattle, very different dynamic for economics, but also for product. So the product is the last thing to zero in on, whether it's new or resale. What kind of product is it? And there's a curveball that's come into the for sale side of the world recently, say over the last 3 years, and that is the build for rent angle. And keep in mind, the build for rent angle is both single family detached. In fact, it's any product you can live in, but there really are two segments. There's the single family detached product that is mapped as an individual unit and ultimately could be sold one day. And then there are the horizontal apartments. That's one map with multiple units, usually 1, 2, and 3 bedroom units. These have become prominent for a couple of reasons. Capital has been chasing this area because there's a decent return there. And secondarily, if you rent, you don't have to do something that you are so very, very familiar with. Qualify for the home, have a down payment, ultimately maintain it. The concept of rental gives a great deal of flexibility. So those are just some of the things we'll think about as we're trying to get a handle on a market.
Yeah, I have a lot of builders that I'm talking to who've been approached for build for rent. They have their developments that they want to build for traditional single family for sale, but now they're being approached for build for rent. So that's an interesting force now at work in the market. So I'm glad you brought that up. You know, one of the things that was most shocking to me with COVID was we saw this significant shutdown, but then very quickly, I think 60 days after the initial shutdown, we saw sales take off. And when I mean take off unlike anything I think I've experienced or ever experienced in my career. Now, I believe I know some of the causes, but I'd be interested in your thoughts at what caused the market to accelerate so quickly out of this shutdown.
Well, the fuel to the fire, and we'll say it right up front and then put it to the side, low interest rates. You know, put that right here, but then push it aside. Ultimately, there was this sociological element of fear that brought us home, and everyone's, you know, hiding at home. And then all of a sudden looking around and going, wow, never noticed those cracks. We haven't painted for a while. This 1,642 square foot, 3 bedroom, 2 bath home that we bought 14 years ago, starting to feel smaller. Wait a minute, lower interest rates, more buying power. Our home looks crappy, we got to go new. There was the sociological and economic factors. And we at Zonda have been tracking the market. We didn't anticipate it would move at the rate it did. We anticipated that there would be a rebound because, you know, anytime you go back to 9/11, the market shut down for 3 months. There was nothing going on. And then all of a sudden it picked back up. Anytime there's a down dip, we usually see the market come back at some rate, but boy, oh boy, it came back at that fast rate. And it was for the reasons I just mentioned.
Yeah, interest rates, you know, from my side, because we're in the finance business, you know, interest rates create incredible purchasing power. And from my side too, I saw a massive swell or shift in the demographics of buyers, specifically in the new home segment. Right now, we're seeing close to 50% of all new home buyers through our business, which is about 6,000 purchases a year, are under 40. So, you know, I think it's definitely a combination of things, but yes, it accelerated unlike anything that we've seen. You know, you mentioned a little bit about buyer mobility earlier, and this is something that's very important to me because many markets and generally smaller markets have benefited from the mobility of buyers. You know, I call that net in migration, people moving into the area, more people moving in than moving out. Now, this has pushed home prices up in a lot of markets that historically were affordable. In fact, in many markets, I recently wrote an article analyzing this point that in many markets, home prices are now 7 to 10 times the annual income, which is way above the national average, which I believe is about 5 times. So, you know, and I've had several guests on it, and so I wanted to just ask your thoughts. Are these markets that are seeing rapid price appreciation because of the migration in, are they at risk if mobility slows down?
Well, think of it this way. You are an Angelino, you live in Los Angeles, and you are living in a home that is small on the outskirts, and it's worth $1 million. And you're in technology, and suddenly your boss says you can work from anywhere, and you're 33 years old and thinking, wait a minute, Austin's pretty cool. You go to Austin a couple of years ago now, go to Austin, and the median price there at the time might have been $400,000. And what your dollar can carry coming from a higher price market to lower price markets, very, very powerful. So the short answer to the question is, I don't believe there is that much risk, but here's the risk factor. That 33-year-old is now 35 or 36, has made some money in Austin, is tired of Texas, wants to go back to the warmer climates or less humidity, and there's an outmigration again. Now, there's a cause and effect here that becomes a bit of a blockade. The person that sold their house in California for $1 million 2 years ago to buy it back, they're going to have to buy it back for $1.5 million. So there's a lock in place that happens. But we're tracking that very, very closely because, Anthony, ultimately that migration was one of the biggest factors that really shifted the markets. And any of the Carolinas, Florida, Arizona, Phoenix for sure, all the Texas markets had higher priced market buyers coming in and looking at the prices and going, what a bargain. And that's one of the reasons prices moved up so quickly.
Yeah, and my worry is that if that migration slows, then the indigenous tribe, the local population, has to support that housing market without the net in-migration coming in. So we'll see how that shakes out. It's just something that I saw happening in the data, so wanted to get your input on that.
Well, Anthony, one more thing on that, because
Sure.
I think what we'll see in some of the markets that are historically lower priced, you can use an Orlando or heck, even a San Antonio in Texas.
Mm-hmm.
The response to these higher prices, and as you said, the indigenous population that has always lived there, the factors of builders responding to that, density is one of the tools they can use. Whether it's higher density detached or we come into some type of attached product or stack flats, that is one of the ways to deal with it. And, we've seen it in so many different markets. It's logical. Some markets it will take longer to be either politically acceptable or acceptable from the buyer standpoint, but it is one of the outlets we could see.
Yeah, and that makes perfect sense because in many of the high cost metros, I live on the West Coast, you're seeing the detached dwelling units, you're seeing the zero lot line detached condo, which is essentially a skinny townhome.
And don't forget ADUs, accessory dwelling units. California is now embracing those in a big way.
Yeah, so you're right. Density is really the answer to affordability, and the challenge for buyers is getting comfortable living that close to somebody. But I live close to people in my home as well. One of the things you mentioned earlier was interest rates, and it's an interesting time we live in right now. Powell just actually testified in front of Congress that he wants to speed up the Fed's withdrawal or buying of mortgage-backed securities. I believe as they pull out, there's definitely going to put upward pressure on mortgages. We don't know specifically how high interest rates will go, but this is the first year in 4 years where rising house prices are not offset by declining interest rates. In your opinion, is affordability a risk or an issue for the market going forward?
Hell yes. And I would call affordability a 4-letter word. And it, to me, is the one thing that will direct how this market slows, levels, use whatever verb you want to use. But my anticipation is that we do see this happen to the market. And that's not bad. A flattening, a slowing, letting the market catch up a little bit is not a bad thing. Ali Wolf is our chief economist. I think you're familiar with her. And we've got an economics department that is constantly trying to model what the impact of even slight interest rates are. And, we're thinking that interest rates next year for 30-year fix could top out at 3.5, maybe go a little bit more. But most of the experts that we're looking at, they're kind of in that 3.2 to 4% rate. Now, it doesn't sound like a lot, but we do see that decline in affordability really cut the edges off. So people that previously might have been able to afford an 1,800 square foot home in market X for $450,000 now can only afford a 1,600 square foot home for $450,000. So trade-offs become prominent for those who are still committed to buy.
Yeah, and you raise a really good point about affordability. Even though interest rates may look low, I was talking with a builder this morning in Florida, and they were asking me about affordability. And the challenge with affordability is with such low supply, pricing is going to continue to be pushed up. And in even a marginally increasing interest rate environment, those two factors will significantly erode purchasing power, of buyers. And one analysis I did for them was to show them, and again, we can see the data with the buyers, is right now 1 in 5 buyers in their market, and this was in Southwest Florida, 1 in 5 buyers down there were at risk. What I mean at risk in terms of this is at risk in terms of qualification, where their debt to income really fell outside what the normal guidelines are. So that's just sort of a way I classify them.
Right.
If I increased interest rates just 0.5%, let's say that's all that goes up, that ratio goes from 1 in 5 to 1 in 2 are now above qualifying guidelines. So while the interest rate looks small, the potential risk is there. It's not catastrophic, but it's something to definitely pay attention to, because buyers are going to have to make compromises. Now, on Jeff's broadcast that you were on, you talked about compromising as affordability becomes a bigger factor. What does compromise look like in terms of a buyer's behavior?
Well, compromise has to do with timing, and it has to do with product. The timing thing is maybe we should wait. Let's see what happens. We were ready to buy, but this interest rate increase is making us feel a little squirrely, so let's hold off. But I still look at that as realistic demand, just delayed. The other part is, as I mentioned before, we can't afford that extra 200 square feet. We can't afford the 50 by 120 lot. We're going to have to go with the 45 by 100 lot. So it's still a location that we like. It's still a product we like, but we just can't get as much of it. So I look at it as timing and amount of purchase power.
Right. Absolutely. So, the question I always like to ask, I see things, but I don't, you don't always know that you're in the middle of change. So how do we know when affordability is starting to impact the market? What does it look like?
Well, there's a couple of things. The media is a plus and a minus. The media is already screaming about affordability. So there's one check, because they know so much. It's always, if it bleeds, it leads. So I'm being a little sarcastic on purpose because, the media doesn't do us any favors. They always look at the negative, but
Right.
There's already conversation about it. So check that box. The second is that we start to see absorption rates slow. The sales rate per subdivision slows. Now, there's another confounding factor in there because we've got limited supply. So builders have been purposely holding back or been unable to put product out. So which is the cause, of that? Is it the lack of supply or is it, demand? And the other thing is that if we start to see that slowdown in sales, and then a third point, builders starting to work with buyers in a way they're not really doing now, some level of incentive. And I'm not talking about price decreases, but if you can come in now, and I know you wanted to wait for a bit, but we can get you closed in the next 30 days, we'll give you upgraded cabinets, and we'll also, put some kind of epoxy on the floor of your garage. Those are going to be some kind of indicators.
I haven't heard of epoxy on the floor being negotiated, but I like that because I do like that look in terms of your garage. Okay, some final thoughts from you. I appreciate your insights today. Looking forward, what does 2020 look like in terms of demand, supply, pricing for the new home market?
I think it's musical chairs. The music continues, there's fewer chairs. And my metaphor is very specific to both builders trying to find the right lots and home buyers trying to find the right home at a price they can afford. It's out there, but you've got to look harder and there's more competition. And I think as we look at 2022, from a macro standpoint, from an economic standpoint, we've got a lot of strength. The new variant of COVID is putting some fear into international travel. But my hope is we've kind of figured that one out. We know how to stay home. We know how to stay safe. We know how to go out, whether we're masked up or we stay away, do some social distancing. My hope is that it's almost a wartime adaptation for the buyer mentality, that the fear is lessened and we've learned some lessons about how to find what we want. But I go back to the musical chairs, Anthony. I think that there's just less of what we want. However, to me, one bright element on the horizon is that we also track lots, And the number of lots that are coming into many of the markets has started to increase 10, 12, 15%, which indicates positivity for more supply in late 2022 and 2023.
Yeah, we absolutely need that. I think that the between the shutdown, the acceleration, the supply chain issues, it's really uh, created a disjointed market. So I think we all would appreciate an opportunity to get back to a more normalized market where we can see seasonality, cyclicality, demand, and all the issues. Well, Tim, thank you so much for being on the program and sharing your insights. From me and for all of us here at the Sales Lab, to our listeners, thank you for listening and have a great week.